Jingjing Liu.
I'm Lillian Smith, and we're the presenters for Student Financial News.
In our topic this week, we're talking about mortgages, the largest type of debt taken on by Australian households. We want to understand a common trend facing Australian families with mortgages, tightening lending conditions, and mortgage stress in family budgets. A recent article in Australian Financial Review shines a light on this problem. The article is Banks Tighten Lending as Borrowers' Budgets Blow Out.
Let's understand the two parts of this trend. Firstly, what are tightening lending conditions? That's where banks make it harder for you to borrow money. How? The conditions upon which a bank will lend become tougher and stricter. For example, rather than assess your ability to repay using the current level of mortgage rates, which is around 5% interest, banks are now assessing repayment using 7% interest instead.
That sounds unfair. If the home loan I want has an interest rate of 5%, why are banks using 7% to see if I can repay the loan?
Banks do this to reduce their credit risk from you, the borrower. Let's say you can pay the 5% interest now, but you can't afford anything higher. Over the term of a loan, 25 to 30 years, there's a real possibility that mortgage rates can move above the current level of 5%. To avoid a future default, banks assess you at a higher interest rate, even though you're currently paying a lower rate. Many banks are no longer doing interest-only loans. This is another example of how lending tightens. So existing clients who finish their interest-only term, which is a short 1 to 5 years, over the total 30-year term, will have to refinance as an amortizing loan, where repayments have both interest and principal.
So what if my loan moves from interest-only repayments to interest and principal? How does that affect me?
It has a very big impact, as you'll be paying a lot more on each repayment. Previously, each repayment is just interest, but now, with principal added, repayments can increase by 50%.
That ties in nicely with the second part of the current trend, greater mortgage stress. An important point from the article is that Australian families are paying 42% of their income on mortgage repayments.
That's huge.
Yes, it is. So if families are forced to refinance their interest-only mortgages to amortizing and face a 50% increase in repayments, then the portion of family income spent on mortgage repayment will increase from 42% to over 60%. I don't think my family could afford that.
Mine neither. That's why the article points to a blowout in the borrower budgets. So Australian families face much greater mortgage stress. We've talked about just 2 examples of tightening lending, but there are more. Are there many Australian families facing refinance from interest only to amortizing?
In another article from the Australian Financial Review, there is $230 billion in mortgages, or 650,000 families facing greater mortgage stress. They have to shift from interest only to amortizing or have to find a way to extend their interest only terms. But many banks are unwilling to do that as they wish to reduce their credit risk.
If you're interested in the full articles, they're available in the additional resource section of Moodle. I'm Lillian Smith.
And I'm Jingjing Liu. Thanks for watching.